You have to understand what your goals are. Do you need cash flow? Do you want the equity bumps? What kind of risk tolerance do you have? Are you wanting to do more kind of a development type deal that has probably larger business plan risk, but maybe larger rewards to it? Or are you looking for more of a stabilized asset? Do you need tax benefits?
What is Agent Ignite? Are you wondering how you can make more money and create a competitive advantage for yourself and your clients in this ever-competitive real estate industry? Agent Ignite is the key to furthering your knowledge, establishing your expertise, and positioning yourself as a go-to expert. They deliver new and relevant knowledge so you can expand your clientele, close more deals, and ultimately increase income. Each month features a new guest speaker who will deliver on what is most relevant for your business. As a member of DMAR's Market Trends Committee, an avid champion for building wealth through real estate, and a self-proclaimed data geek, Nicole will share market trends and commentary that will add value to you and your clients. Staying up to date on industry statistics, coupled with niche topics delivered by industry experts, will help you motivate your buyers and sellers and make you more money. Sign up for the next Agent Ignite session at theruthteam.com/events. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest, she was on the show over 1,000 shows, actually over 1,100 shows ago. And now, man, she has come a long ways in this industry. She's been investing in real estate for many years, but over the last number of years has got more into commercial real estate and syndication and has educated herself above most. I'm so impressed at what she has accomplished. And now she is the director of investor education at passiveinvesting.com. Her name is Whitney Elkins-Hutten, and she's a partner in $700 million in dollars worth of real estate, including over 5,000 units in this numerous asset classes, but more than 1,400 plus self-storage units as well across 8 states. She's flipped over $3 million worth of residential units as well. So just a vast array of experience, that she has in this space and in real estate in general. But she has become an expert just in passive investing. I mean, it's incredible. So we talk through different things, different questions that she gets often, but you're going to hear, what passive investors need to know about the difference between maybe syndication versus a mutual fund or versus a REIT, and things as a passive investor you need to understand and think through, right? But even asset classes and maybe some myths around how to think about asset classes when you're getting started in passive investing and working with different operators. You're going to learn a lot. And there's some things you need to know before you make that first passive investment, maybe your second or third or fourth, if you don't know these things as well. She's even going to talk about some of the biggest concerns right now for passive investors in our current market. You're going to learn a lot from Whitney today. It's interesting saying, Whitney, welcome to the show. But Whitney, welcome back to the show. Honored to have you back on. We've known each other for a number of years now, so it's neat to see your progression and growth in this industry and all the people you're helping now to do the same thing. We were just talking about it beforehand. Your first appearance on the show was show 106. That was February the 4th of 19. So it's so interesting now, well over 1,000 shows later, what's happened for both of us. But I want to focus on you, of course. Give us a little bit about the listeners, an update. What are you doing? What's your focus now? And let's dive into some of your expertise that's going to help them.
Yeah. Well, first of all, thank you so much for, having me back on the show. I loved it. One of our common friends, you and I were just recently at a conference and they walked up and they were like, Whitney squared. So I was just like, oh, that's funny. But as far as me, where I'm at currently, I think last time we were on the show, I was focused, pretty directly on just, building my single family portfolio and, beginning to make those transitions into passive real estate on a larger scale, both actively and passively. And where I'm at right now is I'm the director of education at passiveinvesting.com. And really what I get to do every single day that just totally lights me up is just educate investors on the power of passive real estate and how they can use passive real estate to scale their portfolio. Maybe they want to be a full-time passive investor. They want that lifestyle type of asset, be able to have that freedom of everything, of choice and time. Or maybe they are an active investor and, they are needing to scale their portfolio in a different way that doesn't require all of their time to do it. So I get to engage with people on a daily basis and just kind of, help them understand the asset classes, within passive investing in general, but also, kind of bounce around some ideas on some best ways to, deploy their capital.
What's one of the most common questions or even reservations, hesitations that you have to answer very, often basis, from investors that's keeping them from moving into investing passively in this type of opportunity?
Yeah, I mean, there's really two types of investors that I think that I speak to that, have that like kind of roadblock, hang up. One, maybe it's somebody coming from, stocks, bonds, and mutual funds, typical Wall Street type of investments. And they understand that there's a lot of volatility in that type of marketplace. And so they want to either diversify or just really just kind of pull some of those funds and transition them over into more of a Main Street type of investment. And they just don't understand, like, how is a syndication different from like a mutual fund? So, really what I help them understand is, especially if they've owned their primary residence, I'm like, hey, you own the roof over your head. Really what we're doing in syndications is we're getting a group of people together to buy multiple roofs that go over people's heads, especially if we're talking about multifamily. Little different conversation if it's self-storage or car washes or something like that. But really what we're doing is we're just gathering a group of people together to acquire a larger asset than they probably could on their own. And this larger asset has an element of scale to it in the operations and the expenses to it. We can put better debt on the property and, we can really kind of normalize the risk for that type of investor. So really helping them understand like how this, this investment, it might be better for their portfolio or even just like complementary to what they're already doing. And then you get the second type of investor. I was just talking to an investor yesterday. He's like, I've got my single family rentals, my small multis. Like, why on earth would I like give up that type of day-to-day operational control to invest in a larger, multifamily or self-storage project? And, that conversation is, a little bit different because that investor understands, they're already used to taking their capital into their control, overseeing it, deploying it. They understand real estate. Now, why would they give up that type of control? And it goes back to the 6 points of leverage, right? Especially maybe they're doing single family homes. But if they're all in on single family homes, they're missing out on some uncorrelated assets in real estate. How can they actually take advantage of these different asset classes without having to become the expert in those asset classes? So it helps them, better protect their bottom line because they can diversify without having to, re-engineer their entire operations to add in these other asset classes. They can take advantage of a professional operating team. They can take advantage of the networks that team has put together, all their real estate brokers, property managers, insurance agents, lenders. They can take advantage of their market and expertise so they can diversify outside their market, of where they're currently investing, or maybe even outside the current strategy they're currently investing in. And then, they can take advantage of that operator's ability to get credit and lending. I know when I made that transition from single family to multifamily, especially on the active side, I was like, oh boy, this is a whole different world of lending. I've got to re-engineer this entire process. And, I couldn't just go out there and get an $80 million loan. That just wasn't an option for me. I can now, like, I don't have to be the smartest kid on the block or have the deepest Rolodex. I can right now access an asset with that type of debt on it. And then that operator, I can leverage their ability to get other investors' monies together, that other investor capital, raise that capital to access a larger deal that can be more stabilized for my portfolio.
No doubt. I just think it's so great to reiterate everything you just said. I answer the same question so often, right? It's like, well, why would I go invest in a syndication when I just made so much money selling this single family home that I bought 5 years ago? And I'm like, well, okay, how many times can you do that? How much time are you going to spend, finding the next single family home? Can you do that right now? Are you taking all those calls from tenants? Are you going and fixing the toilets? Oh yeah, I am doing all those things. Well, let's think about this a little bit. I cannot agree with you more just on the amazing opportunity that this business provides to investors. You talked about syndication versus say, like mutual funds, something like that a little bit. What about like a REIT? Why would somebody syndication versus a REIT? Or I hear that often, like why should the listener or the investor think about one over the other or even mutual fund or REIT or syndication? What's kind of your thoughts on that?
Yeah. So for me, I really appreciate in the syndication model is that I do maintain elements of control. As the investor, I get to control the investment strategy, like my investment strategy. What am I after? Cash flow, appreciation, some sort of balanced blend of both. Am I after tax benefits? I get to control that. I don't necessarily, unless I'm selecting some sort of private REIT. Okay. But even then, I don't get to control that, for very long, right? Because the private REIT, they can make a business plan change after you invest at year 1, year 2, or 3, they can make an entire business plan change. And then all of a sudden, the impact to me is different. 2, I get to choose the operator that I invest with, right? Once I understand my investing goals, my risk tolerance, what I really want, now I can actually go out and find that operator that, that we have good rapport with. I might work with passiveinvesting.com, but I've invested with other operators. I've invested with you, Whitney. That is part of the strategy, right? I get to create that diversification across operators, okay, to hedge my risk in my portfolio. And then also I get to diversify the market in which I'm in. I don't get that type of control in a REIT. Okay. And then I can diversify, if I'm staying within a syndication, I can diversify the actual investment that I'm going into. So, even if you're with an operator and you like on a majority level, their deals that they put out, they might put out one deal that you're just like, I'm not really sure about that market. Or, I've got enough B class in my portfolio. Maybe I'm going to go after an A class or a C class property to add to my portfolio. You can diversify into the deal and you're not kind of pigeonholed into that REIT. So, and that gives you an element of control. You can also control the timeline whenever you're in a syndication. Okay. And to some extent, a fund, especially if you understand how the fund is being put together at the very beginning, you can control the timeline and you give up all that control going into REIT. Now, that said, the REIT, that gives you a whole other level of your time freedom back, because now you're not underwriting the operator, the market, and the deal, right? You just write one check to the REIT and kind of like wipe your hands clean and you're just like setting it and forgetting it. You can do that in syndication with a little bit of time investment. I mean, last year, I think I made 10 investments, probably spent 10 to 15 hours total for the year managing that side of my portfolio. Whereas on a REIT, maybe you made 1 hour investment, but you give up a whole level of control.
Love that. It's a great explanation. And I think too, it depends on your knowledge, right? Even being able to do the background, like you've become very knowledgeable in this industry. So your level of due diligence on an operator or even a REIT would be different than some, right? That are just getting started. I love the relationship component, right? That somebody has with you. They develop that trust, and hey, they'd much rather do that than maybe a large REIT as well. And just elements of control that you listed. What about asset classes? I know. And just full disclosure, love passiveinvesting.com team. I've known them for many years now as well. But I know they're going into some other asset classes now that speak to asset classes, maybe for that passive investor. What should they consider? Because, do I need self-storage? Should I think about multifamily? I mean, you hear, there's so many different ways that I could diversify, right? Or maybe different markets or operators but ultimately, let's talk about asset classes in a minute and your preference, or maybe how you would guide that new passive investor.
Yeah, I actually had a really great conversation with a potential passive investor yesterday, a dentist. He was like, kind of like to the beginning of the conversation, he was like, wow, do I do single family, or do I go into syndications? Do I go into syndications? What do I do? And so we really kind of helped him work through, or I did help him work through like a line of questions so he could arrive at his own conclusions of what might be best in his portfolio. Now, why do I bring this kind of back to the beginning? Well, you have to understand what your goals are. Do you need cash flow? Do you want the equity bumps? What kind of risk tolerance do you have? Are you wanting to do more kind of a development type deal that has probably larger business plan risks, but maybe larger rewards to it? Or are you looking for more of a stabilized asset? Do you need tax benefits, right? The tax benefits between multifamily and self-storage are entirely different. Okay. Now you can still do cost segregations in both, meaning we can break the components down on a multifamily building or a self-storage building and accelerate whatever we can to the first 5 years of the project. But the underlying tax schedule in a multifamily building is 27 and a half years, meaning I'm probably going to be able to accelerate more to the first 5 years. On a self-storage building, it's 39 years. And you're buying a garage. Not much breaks down over 39 years. So what I can accelerate forward is less. So really kind of thinking through exactly what you need. So as far as, what asset classes that, we have available and kind of how I orient to them, we have multifamily, we have self-storage, we have car washes, we have real estate debt. We're going to be adding hotels here later on, but really the underlying thesis of everything and how we are positioning assets are all predicated on passive investing, like in generating cash flow and equity. Multifamily right now, where we are in this environment, is a little compressed, meaning I'm probably my pref rates or pref returns are probably going to be closer to 6-7% on those assets. It's going to take me a little bit longer to cash flow them because I'm probably buying a slightly higher purchase price to get into the asset. And so I've got to wait for those rents to bump up. So there are a lot of places, and like we saw this. I don't know your experience, in 2020, in early 2021, it was like, it was game on again. It was so competitive in the market. And then we saw a lot of our syndication group friends overpaying for property. So you really have to be able to make the deal on that. Now, on the self-storage piece, this is still very much a fragmented market. There hasn't been a lot of institutional money that has gotten into the market. We're starting to see that change. And so we're still able to acquire some of these properties from, kind of more mom and pop operators. So there's a greater potential for us to get higher cash flows, initially from day one, and then, hold that asset and either do like some sort of expansion deal on it to where we can, immediately bump up the equity position on the asset. But the cool thing about the self-storage is that we can acquire multiple of those properties, roll it all together, and exit to like a REIT, right? There was a big purchase that happened last year with a major self-storage group. They sold 26 of their properties in one swap. So those type of things are happening. And with car washes are a little bit of a different beast. You're buying real estate, but there's an operating business, commercial business on that real estate. And so the depreciation works a little bit differently. Those are going to be longer holds, 5+ holds. We don't know exactly how. We have multiple opportunities for exits. Do you do a triple net lease? Do you do an IPO? Do you roll up all those car washes to a REIT? You can break them apart and, in packages and sell them to, other groups as well. So, but those are more cash flow heavy and probably not as equity heavy, and the taxes work a little bit different. So kind of put a little pretty bow on it. What do you need as an investor? Do you need cash flow? Do you need equity? Do you need tax benefits? And then really partner with, the investing, the operator to understand which of these probably, and how their acquisition process works, because how we purchase multifamily is going to be different from how you, Whitney, purchase multifamily. So you really need to partner with the operator and understand how that particular asset would work in your portfolio.
Love that answer. And instead of just thinking about a specific asset class, or thinking, well, I like self-storage more than multifamily, or I like multifamily more. It's like, well, what do you really need for your personal portfolio? What's going to help you build the most wealth as fast as possible, right? With maybe the least amount of risk. And thinking through the tax benefits, I thought that was a great point as well. Now, one asset class versus another, just the tax situation for each of those, because it's not the same, right? It's not the same, and depending on how much you've invested passively in the past, how much depreciation you're already getting, like all those things need to be taken into account, don't they? So, what about your biggest concerns right now, Whitney, for passive investors in just our current market? I know that's like there's listeners that are wanting me to ask that.
Right now, it's chasing yield. And I say that especially in the single families. I still have my single family portfolio. I use them as like little mini ATMs. I harvest the cash flow, I harvest the equity off of them periodically to continue to scale the passive side of my portfolio. But it's really chasing yield. Like I got an email from an investor the other day, and he's like, okay, I got $100,000 that I want to invest. I must be at 8% preferred return. What do you got for me? And I was like, well, again, we get back to those, like, what are your goal questions? What do you really truly need? And like, what kind of risk are you willing to take on for that type of, that 8% preferred return? Or, the other parameter, he wanted a 2.5x multiple and, and a 20% IRR. I'm like, well, what kind of risk are you willing to take on for that? So, really we have, for what investors, can, how they need to orient. It's really about orienting to today's market where we're at. We're a little toppy in some parts of the cycle, like multifamily is pretty toppy. Self-storage is still on the climb right now. Car washes are a new beast for us. So you just really need to understand and take care of where you're at in the market cycle and be willing to get in the game, because even if you do like a deal that's 15% IRR, if it's stabilized, if it's cash flowing, you're hedging your risk position. You're investing in an asset that's going to give you inflation protection, especially right now when we don't really truly know what the inflation rate is. And then once kind of that part tampers down, your capital is going to cycle out, and then maybe it's a different type of market, and that like 8, 9, 10% preferred return is back, right? So it's just, you have to get in the game, but you also have to understand that it's not all about chasing yield.
Great answer. Love that. Yeah. And I love how you approach it, asking them questions, right? And helping them to come to that answer almost on their own, right? Helping them to see a bigger picture than just that preferred return.
Well, I mean, the real key thing here is capital preservation, where we're at in our market. Like, how can you, at least that's how I am orienting to everything. That's the reason why I still invest in real estate actively and passively. It's capital preservation right now. And, I think a lot of investors they think like, what could happen on the property where I could lose all my capital? That's still a risk. We need to mitigate that, right? That goes back to the operations team. But right now, if you've got money in the bank that's sitting there, guess what you're doing? You're losing capital.
No doubt about it. Yeah, you're losing a lot sitting in the bank. What about, even thinking through that, and as investors are looking to invest, and I ask this almost to every operator, or investor that we have on the show, but just preparing for that downturn, right? How do you like to see an operator prepared for a downturn? How do you all maybe prepare or answer that question to investors, maybe on a deal by deal basis, or however you want to answer that?
Yeah, when we talk about the downturn, nobody can really truly predict it. Do we think that we're actually like at the top of the market in some asset classes and that we might see some sort of slide? Yeah. I mean, that potential is always there. I mean, I remember listening to economists 2 years ago, they said, we're going to have the roaring 20s. And by the end of the 20s, there's going to be a huge recession and depression. Guess what happened? COVID. That's all here now. What was supposed to happen, that whole cycle accelerated so much faster. So I don't think it's ever about preparing right now or like for a future recession. It's like you have to be thinking about that risk mitigation all the time, right? Yep. But you can't always stay on the sideline. So, okay, off my soapbox there on that. But so how do you prepare for that? One, really partnering with the operator, right? And getting to know, love, and trust that operator, understanding what their investment strategy is, making sure that it aligns with your portfolio. I've done this mistake for myself. I got one of my first passive deals that I did, probably 5 years ago. I swung for the fences on a deal with an operator that one of my friends knew. And, I lost money on that deal. It happens, right? So really vetting the operator. What is their knowledge about the investment strategy? How long have they been doing this? What is their bench, their team like what is their knowledge and expertise? What is their, how have their deals looked? Have they gone full cycle? What have the exits have been? Really kind of digging in on that operations team. Also the market. I really love being in growth markets for a very specific reason, because I'm hedging my bets with the market. Is the population, if I'm doing multifamily, is the population growing? Is the incomes growing? Are jobs growing in that area? Is industry coming to that area? Is the industry diversified? Even getting down to the deal level, what is the population of the tenant base that lives on that multifamily property? If we're talking about multifamily properties, how are their job profiles? What are their income profiles? Like, we can aggregate that data and take a look at it to hedge our risk in that particular investment. The debt on the property, even getting down to the deal level, how is it being underwritten? I know I jumped to the debt, but I'm going to backtrack a little bit. How's the operator underwriting the vacancy? Rent increases. Are they maybe doubling the market vacancy? Maybe even tripling the market vacancy? Okay. That we saw a lot of operators got stung with that during COVID, right? They were underwrote at a 3% market vacancy. Guess what? They had a 9% economic vacancy on the deal, right? We want to see conservative underwriting, on that. We want to see conservative rent projections, right? If we're okay with the conservative numbers, if we blow past those numbers, everybody's happy, right? Under promise, over deliver. And then the debt. I think the debt is really kind of a key investment piece right now. Is the debt being placed on the property going to allow you to hold the property through kind of this volatile environment or this unknown environment? I want to see interest only for at least an interest only rate, at least for the term of the hold. All right. With options to extend that rate further or, swap the debt for something else. Should I have to hold it, longer than 5 years or 7 years, whatever that timeline is.
What about your best source for meeting new investors right now?
I'm digging conferences. I still do a lot of online stuff. It's funny, like I would never do an online meeting before COVID. And then I felt, during COVID, I was like, this actually really fits my personality very well. I also do like a lot of like educational master classes. I do a weekly master class and it's live. And that's exciting for me because I can invite pretty much anybody that I want to there. And we get to have not only an educational portion of the conversation, but like I kind of call it the after party. Investors stay on and then we just kind of hammer out all their questions and, really get to know each other.
That's awesome. And how did you, I guess, lean towards some kind of like online platform or that meetup? What would help the listener to break past that, the limiting belief that they can't do that, just like you did?
You mean like if they're an investor and they want to find operators?
Yeah, well, maybe they're an operator though that's looking for passive investors. They'll just be doing it like you've done. I mean, you're providing so much value to those investors. How could they create something like that, or what helped you to push yourself out there to being willing to have that online class like that?
It was. It's funny. Like it wasn't even really my idea to begin with. Somebody like suggested it to me, like, you need to do a masterclass where you kind of whiteboard the answers. And I mean, every objection in my head, just like the alarm bells went off, and the imposter syndrome, the what if, like even down to me. And I'm like, the technical piece of it, like pushing the button and like, what happens if my computer crashes, right? Like, what are people going to think of me? And here's the thing. This is really what I found is that people just want to connect with somebody that's genuine. And you know me pretty well, but also I probably exhibited it right here in this episode. I and all over the place. I'm not the most polished speaker, but I really love what I do. And if you love what you do and you generally want to help people, you're doing a disservice by not putting yourself out there and, either educating or, putting the deal in front of somebody, because that deal, if you're holding it back, that education piece, that deal for yourself and not putting yourself out there, you're doing a disservice because that investor's looking for you.
No doubt. I appreciate you being real about that. And being willing to share everything you've learned from doing it passively and now just being much more ingrained in the business. What about some daily habits that you have, Whitney, that have helped you achieve success?
My biggest daily habit is me putting my oxygen mask on first. That's kind of what I call it. I mean, we probably all heard that analogy. You get on a plane. I have a 9-year-old. So we're about to get on a plane this weekend. The the stewardess comes around. She says, make sure you put your mask on first and then purse. I'm like, so you have to do that. So I get up, pretty early in the morning and, do what I need to do. Like I focus on my physical body, my spiritual self. I, get out in nature. Those are my first things that I do during the day. And when I do that, I'm like, I can feel like I could handle anything during the day. I'm far more grounded. I can bob and weave with whatever's being thrown at me. When I don't do that, when I haven't taken care of my core self first, I don't feel like I could serve others to my fullest capacity. And that includes my family. That
takes some self-discipline as well, doesn't it?
It does, because especially all the dings that you get on your phone and the need, if you're working with investors, the compelling feeling that you have to get back to them really immediately. But even just taking, maybe it's a half hour or an hour, but just taking that time for yourself. This might sound really weird, but I went for a run yesterday and my headphones broke. And here I was out in nature with my, no podcast. And at first I was vibrating. I'm like, oh my gosh, I'm not getting my podcast in today. And then I'm like, wait, I'm in nature. And I could just, my brain just could unwind and started thinking. And by the time I got home, I was I had my top 5 problems solved for the week. I'm like, yes, let's go. So it's just learning to, put yourself first and not, for me, I had to learn that that's the best way that I can actually serve others is if I put myself first.
How do you like to give back?
Well, I love coaching my daughter's soccer team. We do a lot of things here locally. I love educating investors. So I love doing webinars for them. I have a speaking event tonight. So those are the things I just love, doing what I can to serve my family and my community, especially with kids, but also educating investors about the power of real estate, because really at the end, it's about creating freedom. And that freedom for everybody is going to be different. But when you have that freedom of time, freedom of choice, freedom to travel, freedom to sit at home on the weekend in a hammock and read your book, whatever that freedom is, it's kind of like putting your oxygen mask on. You're going to be able to deliver bigger and better things in your world.
Whitney, I'm grateful to have had you back on the show, and you've given a lot to us. And I know the investors that are listening today have learned a lot. I'm just grateful. Even just you talking through syndication versus mutual fund versus REIT, and then asset classes and how the investors should think about those things. And even the concern of chasing yield and some issues behind that. I think it's been so beneficial. I know they've learned a lot. How can they get in touch with you and learn more about you?
Yeah, absolutely. Thank you again for the opportunity to be here and talk to everybody. You can find me at passiveinvestingwithwhitney.com. And, we talked a little bit earlier about the show is getting into passive investing can be a bit overwhelming. So I've got some free resources there for investors, a simple checklist, a 10-step checklist to get into your first or next investment. I have a book coming out here, hopefully by April. That'll be free to everybody that goes there. And then you can also find my weekly masterclass there and get registered for that. But all of that is at passiveinvestingwithwhitney.com.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the number one resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.